Are we like centered on camera, Joanna?
I think it's okay. Yeah, that no problem, don't move. I think it's correct. Who needs to move?
Closer here?
Yes, closer. Yep.
Okay.
Better.
All right. I feel like I'm flailing out here.
Well, YouTube sees you doing it, so that's nice. Okay, we're ready. Ready, buddy?
Let's do it.
Let's do it. Welcome, everybody, to your weekly edition of the Not Your Average Investor Show. Today, we are talking about something that's on everybody's mind. It is the war in Iran and how war may affect housing prices. We're also diving back into last week's quarterly market update, quarterly market outlook, and answering some of the questions we didn't get to. And this is essentially a extended version of like what we were talking about last week. So happy to have you here. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
Fantastic to be here with you, GC, and also fantastic to get a chance to really do our usual tradition that we went short on last week.
Yeah, we got to go all out this
You know
time.
what it's called?
The roll call, baby. John Henning.
Lead off
Wait,
hitting a second.
Oh, that's Lee Bishop. I was looking at John Henning. John Henning is our leadoff batter. The MVP, of course, is Mr. Lee Bishop.
The MVP. John Henning is the leadoff batter. We got the early bird in the house.
Mr. Dean Curry. I got to talk to Dean this week. He's doing
Yeah,
good.
good to hear.
Good to
Dean,
talk to Dean.
Happy to have you back on the show, man.
Yeah.
Good to know you're doing well. The patron Santorios.
Michael Santorios.
Coming up with a spicy topic for a future show.
Can't wait, Michael.
For that. We got the fairy godmother of the Net Average Investor community.
Miss Jen Filson.
Miss Jen Filson from lovely Monterey, California. You should have seen the videos in the community chat of Jen blessing Nadeem during his birthday. So
really?
Yeah, it was really awesome.
Nice.
We got Julia Uchter.
Oh yeah,
from the JWB team.
She's a super special part of JWB. Right. Nice to see you, Julia.
Have the team here. Mark Norman in the house.
All right, Mark. I got to talk to Mark as well.
Yeah,
man, this is just like a you know.
Were you just DMing people?
You know, it's just sliding up into DMs.
I've
had a few awesome conversations with clients lately. It's been really nice to connect.
We got Saran with a plan in the house.
Saran with the plan.
Good to have you, Saran Jennings. You're supposed to say the full name when I say it.
Is that how this goes? Okay, I didn't realize that for Jeff
Moronco from Maryland. Good to have you. We got the Ringmaster.
Andrew Barnhill.
We got the KOB, King of the Beach.
Christopher Lee.
From Bernardino Beach. Who else we got in here? We've got Nicole Pimental.
That's right. JWB representing.
JWB. I love that last name. That's phenomenal. We got Il Maestro.
John Williams.
Mr. John Williams, world famous composer. We got Benny Valsamakis in the house.
All right, Benny. Nice to see you.
Benny. We got Abdul Hamid Ayubzai from down Texas.
Is that a new name? New name. Welcome.
Welcome to the show. Abdul, the key to getting the most out of this thing here is being active in the chat. So whether you're Abdul or anybody else that's new, being active in the chat, asking people questions, you'll see that everybody's engaged. You'll make a new friend. Happy to have you here. We got LinkedIn Lowry in the house.
All right, Ed Lowry, nice to see you.
Herrera is in the house.
Just seen my friend from the tour.
Robin Schofield is back from New Hampshire. Good to have you, Robin.
You.
We got our regulars, Gary and Rosalind Riley from Marietta, California.
We regard you.
We got Sergio Prieto.
Go Gators.
Go Gators, the undercover Puerto Rican. We got our favorite smile from the Pacific Northwest.
Pamela Myers, of course.
We got Linda Mercurio.
Right,
Linda needs a nickname.
We need to work on this nickname. Yeah.
Gotta give you a nickname. We got the Maven from the mountains of Denver.
Ms. Leslie Wilson.
We got Janita Floyd from Atlanta, GA.
New name?
Oh,
Janita. Welcome.
Welcome to the show, Janita. Good to have you. Same advice that we gave to Abdul as well. Make a friend in the chat. What else we got in here? We got Big Pop in the house. I love it when he calls him Big Pop.
Pops, how are you, my man?
The co-founder of the co-founder. Greg's dad is here. Who else we got in here? All right, cool. Oh, and Jay Corrupt.
All right, Jay's here, man. It's a party now.
I feel like, Jay around summertime, he gets like active.
Yeah, he's around.
He's not a bunch
we get
of
him to
stuff.
stick.
See, we stick around.
How many in a row we can get Jay to be here?
Stick around, Jay. I love it, Jay. Good to have you, man. Before we go into anything, I heard there's some breaking news, bro.
We do have some breaking news, guys. We have an incentive package that we're announcing for the month of April. As you notice, we have done this, man, once, maybe twice in the calendar year last year. And guess what? This is the time that we're going to roll it out here in 2026. So it is a new and improved and updated incentive package. All in all, your total incentive package is somewhere around $14,000 to $19,000 per property you purchase. There's no limit to the number of properties that you can purchase. I remember I helped a friend purchase 7 properties at one time during the incentive packages that we were offering, and he was able to walk in literally with dozens of thousands of dollars. And the great thing about these incentive packages, it's in the form of a seller concession, which if you're not sure what that means, that just means that we actually pay to buy your interest rate down. So your interest rate is still going to be 5.25%. Or somewhere about there, obviously, depending on your credit. So it comes in the form of a seller concession, which we use to buy your rate down. It also comes in the form of a maintenance credit. That's somewhere between maybe $9,000 to $13,000. And what that does is it takes care of your first however many years of maintenance right off the bat. So maintenance costs can be something that is painful in this investment. You know, you purchase with the incentive package and you remove that. You've got that covered. And then it also comes with your first year of property management fees waived. We all love that as rental property investors. So between about $14,000 to $19,000, depending on the asset, the property that you purchase. And we're really excited. So everybody who has, done your annual planning, you've sat down, you had your conversations at Summit or thereabouts, and you were able to look at the JWB income passive income planning tool. You're able to learn how you're able to harvest your equity and deploy that equity so you can get to your financial goals. This is a great time in April to take advantage. We're super excited about it.
All right. So April showers.
There you go. April showers.
April showers us with incentives, right? Like good opportunity to lock in a lower rate, lock in a little extra cash flow based on these builder incentives that you guys are offering.
Exactly. There you go.
Very, very cool. I may be taking you up on that myself.
There you go.
Little update on the roll call. We got MJ Rueda, who is a newbie from New Jersey.
MJ.
Same advice applies. Make a friend. Janita Floyd said, perfect pronunciation of her name. Bravo.
Way to go.
I told her this is a rarity.
You don't know what that means to this guy.
No,
he's going to be riding high for at least a week after that.
For sure. And Laura Colby's here from Washington.
All right, Laura.
Good to have you back, Laura. All right. So, Hervé Francois in the house. Hervé, good to have you, buddy. As always. So, GC, we cranked through that quarterly market update. Good job by you, by the way, putting that thing together.
Thanks, man.
Did not have a lot of time to get at these questions, which if this screen goes out again, I'm not going to be able to read them. But that's what's happening here in studio whenever you see me reach out. Let's crank through some of these, get everybody the answers that they were looking for. First one was anonymous attendee from France asked, how is overbuilding of multifamily apartments impacting single-family rents and time in market? Is there a marked difference in tenant base for both and any market data around this?
Yes, lots of market data around this. There is a difference between the multifamily space and the single-family space when it comes to rent price appreciation. The data that I was sharing with you about single-family rents was showing that they're basically flat, a little bit up. I think it was 0.2% or so rents are up this year for single-family in Jacksonville. If I was to show you the multifamily rents, it would actually be different. I think it's down about 2% overall for multifamily. And what's been happening, as this friend of ours, Anonymous Attendee, mentioned that there was an overbuilding. We went from undersupplied in multifamily to oversupplied very, very quickly in the span of just a few years because there was so much capital that ran into multifamily and so much capital specifically in Jacksonville because they love the fundamentals here, that it flipped from undersupply to oversupply in multifamily. And because of that, it has taken some time for those rents to be absorbed, those properties to be absorbed. And this is a risk in the multifamily space that you just don't have to the same degree in the single family space. Now, if we flip to the single family space, we are undersupplied in single family still. We have been undersupplied for better than a decade, and we are going to be undersupplied for the foreseeable future in single family. So even though we have these affordability challenges in both single family, multifamily, on the sales market, all that good stuff, what you're seeing is that single family rents in Jacksonville are still growing a little bit, right? So you haven't had any decline. So there you go. There is a difference. Single family, again, we love the asset class because you just don't have the same risk factors as even some of the other very similar types of investment in real estate.
Yeah, one of those underrated things in single family workforce housing, right? Like it is a risk mitigated asset class within risk mitigated asset classes.
Right.
Impossible to mass produce, chronically undersupplied, and just seems to kind of like make it through all these different things. So even when like people talk about, man, I want to own multifamily because it's multiple doors and that like kind of like does what it does for my, like they see it as risk mitigation and cash flow. There's another way to do it. You can just buy 4 different like single family homes, and you're truly risk diversified in a way that you can't oversupply either.
Sure. And there's other advantages for buying single family versus multifamily when it comes to how easy it is to get financing and how home price appreciation works, and the fact that single family is based on what other things are selling for in the area, not necessarily having the same interest rate risk. So yeah, just a lot there beyond the surface of single family versus multifamily. And if you're interested, reach out to JWB. We can give you perspectives. We own and manage both.
Yep.
So happy to give you both perspectives there. But single family is what our client base really enjoys.
Sounds good. One of the questions we had was MVP Lee, who is doing his MVP thing right now in the chat and making a new friend.
Nice.
He was asking, is there a way that we can send people the presentation that you put together last week? Is that an option?
Just reach out to your portfolio manager with JWB. Happy to share all the slides that we have. And if you're not a client yet, just send an email to info@jwbcompanies.com and we'll find our way to get them to you.
Sounds good. Jen Filson, fairy godmother. We talked about this a little bit on the show, but you have an update on this, right? She said, I have an auto repair shop clients in Washington State that serve military towns, and a big deployment drops the city's population down about 30%. Regarding deployment in Jacksonville, do we have any numbers about how large deployments will affect our rentals? I know that we have a diverse economy in Jacksonville, and sorry, man, this is a challenging one. Diverse economy in Jacksonville, but I'm curious if we know how many rentals that JWB manages have military folks who could leave at a moment's notice.
So I love this question. A lot of times when you guys ask questions, Pablo and I will take this and really run with it. And sometimes it turns into even a show topic in the future. And so as I got your question, Jen, I first went to the team and I said, hey, do we have a spike in military move-outs here in Jacksonville? The answer was no. And then I started to do some more research and just see if there's articles written about large deployments in Jacksonville, even though we, of course we are a military town, and I couldn't find anything. So without having actual data to share with you, I would say this is not a point of concern here in Jacksonville because I'm just not hearing anything about it. I'm not seeing anything internally. And, but where it started to take me down the path is I was like, you know what? I wonder how Jacksonville's military dependence compares to some other really, really dependent military towns. Because, as Jen was mentioning, she is in an area that, she's seen a spike in folks being deployed.
Clients. She's got clients in an area.
There you go. Yeah, exactly. That makes sense. So I started to go down that path. So I put some research into it. I hope to share it with you guys either in a breaking news section or maybe in a show topic. We'll get together on it and see if we want to turn it into an actual show. But I wanted to look at the impact of Jacksonville's military dependency and demand from the military on our rental, on rental demand, and compare that to other parts in the country. There's some good stuff there. But
I'm going to take you up on that. We're going to do a show on like, does it make sense to rent to government entities and military and stuff like that?
Yeah, because there's pros and there are cons, right? I had never really thought about a con being a heavy military dependency, but obviously in wartime, you can have large deployments, for military orders and whatnot. So anyways, great question. Nothing to be concerned about in Jacksonville, nothing to be concerned about as far as internally at JWB, as far as a large number of deployments. And we'll keep you posted on some of this other good stuff that we're going to share.
The mystery man, Denny Davies, as we know, he is a high-ranking officer in our armed forces. He puts here, Greg, I am not tracking an abnormal deployment from Jacksonville military.
That's the end all be all right there. There you go.
We'll take
Mystery
that.
Man, thank you very much for your contribution and everything that you do for our country.
Yeah, thank you, Denny. And Jen says, my clients in Bremerton, Washington, and Calcium, New York are very military dependent. You can use those numbers as you compare them with NAS Jackson Mayport. Could be an interesting cross section. We also talked about on the show, right? Like there is a difference in a consumption economy business versus versus what is like a critical need, like business,
Mhm.
right? Like, so I could see, without any data to back this up, right? Like, if you are a military family
Mhm.
and the head of household goes, gets deployed, that family still stays paying rent, I would imagine.
Sure. Yeah.
If they're renting a home.
Yeah.
Whereas if you were in auto service and the owner of the car leaves, like nobody's bringing that car in for service.
Okay.
Right.
Yeah.
So I think I think
Makes
there's a
sense.
little bit there, but I think tracking this idea of like of population shifts and stuff like that is pretty interesting.
Mhm.
And Denny, welcome to the show, man. I can't believe you didn't check in on the roll call, man. The
He
mystery
was
man.
waiting for his moment.
He was such a mystery. All right. So another one from anonymous attendee says the P&I stays the same while insurance and taxes go up. How will these two variables affect this asset and its returns? Will property taxes disappear for the Florida for the investor if Florida eliminates them?
Yeah. So, big picture, we'll save the question about property taxes disappearing here for the second part. But big picture, what the question is asking is with rents going up, as they generally do, they go up about 4% a year here in Jacksonville. Is that enough to cover the increases to property taxes and insurance costs? And historically, the answer is yes. It's a strong yes. If you've got $1,500 a month rent times 12, it's $18,000 a year, and your rents go up 4%. I happened to do the math right before we got on the show. That's about a $700 a year increase in your rents.
Yeah.
Right. Call it about $60 a month, somewhere around there. Well, your property taxes for your JWB turnkey rental property are somewhere around $3,000, maybe $3,500. Your insurance costs are somewhere around maybe $700 to maybe, I don't know, $1,200 or $1,400 or so, depending on the type of property that you have. So all in, your cost basis is a lot lower. And those costs, taxes and insurance, tend to go up about 3% a year.
Okay.
So it's a large disparity in your favor in normal years. Now, not every year is like this. And I think the basis from where our friend is coming from is there has been a lot of noise about property taxes and insurance rates in the state of Florida going up over the last, call it 4 years or so. The great thing is we've done show after show, and I hope you keep coming back, anonymous attendee, but we've done show after show talking about what's really going on for Florida insurance. And the big spike that we did see in Florida insurance has actually passed. There's stabilization in the insurance market now. So there's a lot of reasons why that has happened. And the state legislature stepped in and really cooled a lot of what was driving those really high increases and set up a functionally much better insurance market here in the state of Florida. So don't have to worry about that. Those insurance spikes, it's not happening in the last 2 years. And then property taxes are a function of home price appreciation for the most part. So home prices have largely been flat here for the last year. Property taxes are largely going to be flat this year. Rents are going to maybe go up a little bit or so. That's kind of what they're doing right now. But I would encourage you to think longer than just the last year or longer than just the last 4 years. Think about this as an investment over a 10 to 20-year hold. You're going to win when rents go up largely kind of close to inflation. And that's going to be a much higher increase than your property taxes and your insurance costs will be.
Good answer. I hope that this person that asked this question came back. We don't know because they're anonymous, but we don't take for granted that you show up here and you ask these questions. Last week's show was something that we jammed through all these different things and had to get it done because it's the market update. But these shows we always answer, like almost every single question, right? So excuse me. Next question here. A regular guy with extraordinary questions, Mike Foster, says, generally, do you find that JWB property rents increase at amounts greater than the combination of property plus taxes plus insurance increases?
Answer is yes. I kind of answered that one with the last question. I forgot to address the question of property taxes disappearing for the Florida investor from our friend Anonymous Attendee. There's a lot of noise right now, honestly, a lot more noise than I even expected in terms of eliminating or drastically reducing property taxes in the state of Florida. It's working its way through the Senate and the House. Nobody really knows if it's going to be passed or what form it's going to be passed, but there's a lot of noise and there's some serious momentum. If this was to happen, this would absolutely drive housing demand and absolutely drive home prices up in the state of Florida. So for investors, if we're just thinking from the investor lens, this would be a big increase to your return on investment. If we take our investor lens and put it to the side and wonder if this is the right thing to do, I think there's schools of thought on both sides. But if this happens, you want to own real estate in Florida, in my opinion, because easy to see how us being the only state that doesn't have property taxes and us state being the only state that doesn't have property taxes and no state income tax would drive a lot of people to want to move here. And I think that's why our governor really wants that to happen.
Yeah, man, that's really evolved, huh? Like,
yeah,
when we first heard this news, kind of like, we're like, yeah, obviously this would make things go up and sounds like a panacea for real estate investors.
It'd be a short-term real boost.
It'd be a short-term real boost for investors. We really didn't expect it to happen when we first started talking about it.
Yeah.
Right? Like, it just kind of seemed like one of those things someone throws out there to gain favor.
Yeah.
But there really seems to be some momentum happening with this thing, huh?
There does. There does.
Yeah,
and it seems like there's so much momentum that, elimination still seems like kind of a long shot to me, but some form of property tax relief seems sort of likely in whatever way, shape, or form, which when you have property tax relief, that just leads to housing demand, that leads to better affordability, and it leads for the opportunity for home prices to go up for the assets that you own.
And patron Santoris, Michael Santoris, is saying that it's his understanding that property taxes would only be exempt from your primary residence. So as investors, we'd still pay taxes on it, but that would still drive home price appreciation up.
That's exactly right.
Right.
That's because it goes back to how is your property valued? Your property is valued and your appreciation comes from what do other people pay for that property in the same neighborhood. So if it's their primary residence and they don't have property taxes, then they can instantly afford a much higher mortgage payment. And instantly the home price goes up around you. So you benefit from that because your appreciation will go up as well.
Lincoln Lowry brought that up as we were talking about it as well. All right, cool. So another one from anonymous attendee. Honestly, wish we would have, if this is the same person, I really feel bad that they had so many questions that we didn't get to them. Will the properties cash flow with 25% down after all reserve requirements, CapEx, maintenance, vacancy, and potential downward pressure on rent? Or are these more appropriate for appreciation-oriented investors?
These do positively cash flow at 25% down. They do because of the large incentive packages that are being offered by builders, of which JWB has a large incentive package that we're offering. So that is the point of the incentive package, to make sure that we're setting up every investor so that you are cash flow positive from day one. So yes, cash flow positive with 25% down. That does include all of the requirements for maintenance, vacancy, CapEx, which is capital expenditures, which are big ticket items that you should plan for maintenance costs. So yes, all cash flow positive with all of those things. And you mentioned downward pressure on rents. We don't see downward pressure on rents. Like I mentioned, from a macro perspective in Jacksonville, we're seeing rents are largely flat or slightly positive. They were slightly positive last year. And as we look out in future years, we pay a nice sum of money to some really smart people out there and consultants that help us understand where the market's going to be. Everything that I have seen is that, rents in Jacksonville are expected to increase somewhere in the realm of maybe 2 to maybe 4% in the coming years. So I don't see downward pressure or depreciation when it comes to rent rates. And you had asked, is it more appropriate for appreciation-oriented investors? I think it's great for cash flow plus growth-oriented investors. When you invest in a growing market like Jacksonville, where we are the #1 for U.S. population growth since 2022, #1 in the country. Yeah.
Did not know
Yeah,
that.
you didn't know that
Not
yet?
surprised.
Oh, I thought I shared that one with
I
you.
had not seen that statistic.
Yeah, we are #1 for population growth from 2022 to,
People are listening, man.
So yeah, exactly. We're bringing them all from everybody who comes to the Not Your Average Investor Show.
Yeah.
But yeah, population growth drives home price appreciation, especially over the long run. So I think it's a great play in Jacksonville for both cash flow and growth.
Well said, GC. Like my head goes to this idea of, I'm blown away that we're the #1 place since 2022. That kind of like took me back a little bit, right? Like the statistics that we talk about of #1 corporate relocation place, fastest growing median income in Florida, like all of that stuff adds up to what I would imagine is this momentum of people moving here, add the chronically undersupplied single family home asset class that's just impossible to build at the rate that it's needed right now.
Yep.
Much less, like we're not able to build at the rate that it's increasing, much less make up the deficit of what is needed, right?
Exactly.
It's kind of like the things that we're talking about, right? So
think high floor.
Yeah.
High floor.
Yeah,
Everything you just said there means high floor,
High floor.
and the opportunity for upside.
Yeah, makes sense. Makes sense. That's really cool, man. I'm gonna stew on that statistics for a little while.
I got a few good stats to share with you.
Okay, cool.
Yep.
Again, from anonymous attendee, is JWB able to handle co-living and alternate rental strategy to help with vacancy owner rent issues?
Well, we don't have vacancy or lower rent issues. So we don't need a strategy to help with that. I just checked, our vacancy is less than 3% right now for a portfolio of over 5,700 homes that we manage. So we don't have those issues. And additionally, we are not built to handle co-living. That is a very different type of property management. And it's not, we are very focused on delivering for clients and doing what we do to be the very best at it. And so co-living would be a diversion. So we are not built to handle co-living.
Okay. Kevin Glacken asks, is JWB no longer buying single family rentals in Jax?
No, we are buying single family rentals in Jax. In fact, we share this. I share basically our business plan every year in the beginning. I think we do it in January. And so anyways, I walked everybody through our business plan. We're increasing the number of purchases that we are doing this year compared to last year. I don't remember the number right off the top of my head, but somewhere around maybe 100, 150 properties is what we'll purchase here in Jacksonville this year.
Okay. MVP Lee told me that my microphone was low, so I went and checked it just in case you were wondering what I was doing.
Love it. I thought you were just piecing out. You were done. You just weren't interested.
All right. Okay. By the way, thank you, MVP Lee, for always bringing the value, right?
Mm-hmm.
Michael Santoris in the chat says, my cousin lives in an $825,000 home in Stowe, Massachusetts. His property's taxes are heading north of 13 grand. He's selling and moving to Florida.
There you go.
Another data point.
Yeah. You don't even need property taxes to be eliminated for it to be a good move to come from, from the Northeast to Florida from a property tax savings perspective.
Yeah. The weather does a lot too.
True.
Okay, so from the patron Santoris himself, Greg, curious about your take on Florida Senate Bill 48, allowing ADUs on single-family home lots, and how you think it could impact the Jacksonville market. If it passes, do you see the ability to add ADUs on single-family homes, especially on larger lots, meaningfully increasing property values?
Yeah, so I did some quick research on this, patron Santorios, and this has been a topic that we've been talking about internally as when this would happen for many years, or what the impact would be for many years. Ultimately, Florida Senate Bill 48 is a bill that would require every city in the state of Florida to allow ADUs. And an ADU is an accessory dwelling unit. Think about a separate structure on your existing single-family home lot that you might be able to build a 1-1 studio. Apartment or
used
whatnot.
To be called a mother-in-law suite, right? Something like that?
Yeah, mother-in-law suite, sure, but it's
Efficiency.
an efficiency. There you go. It's a physical detached.
We now have acronyms for everything.
There you go. Yeah, and so a big topic, as we all know, is affordability. So being able to increase the amount of housing, increase the density, is the key to having our housing become more affordable. It really, really is. And so this would be a great thing to help with affordability. Right now, as the way it is cities have the opportunity to restrict ADUs or to allow them. Jacksonville restricts ADUs. Mm-hmm. So you are only allowed to build an accessory dwelling unit or an ADU on a property that is your primary residence. So you can't build it if you don't live there. Mm-hmm. You can build it anywhere in Jacksonville, but you can't do it. So like our client, we can't build ADUs on lots that we sell with rental properties on that you rent out, right? So I think it would be a great thing for affordability. I'm hopeful that it passes. It's somewhere in the legislature. I think it gained momentum and then it expired, but may come back again. We'll see kind of where it is. I do think that this would have a great impact on housing here in Jacksonville. I think it would help with affordability. Mm-hmm. I think what you'd see is that overall housing prices would probably go up because lot values would go up because you could build. Yeah, you could do that. I think it would have the biggest impact in the higher priced neighborhoods rather than some of our workforce housing neighborhoods. I was just checking with my business partner, Alex, right before the call, and I was like, how much does it cost to actually build an ADU?
Yeah.
And
you were like 50K, right? Something
yeah.
like that. He laughed at you.
He laughed at me. Yeah. Because we are doing this for some of our projects where it makes sense to do this, not something we're rolling out to clients. It's a more of a one-off thing. And he was like, you're going to have a hard time building an ADU for less than 100 grand right now. So on a JWB rental property lot. So all that means is that there will be some, if this passes, there would be some, I think it will overall raise property values. It overall will decrease rental growth, which is because that's what we want for home price affordability.
Yeah.
But it would increase the cash flow on the properties that you own if the numbers work to where we could build an ADU on it and have it, have the numbers make sense. So overall, I think a great thing for the marketplace if we have that passed. I don't see it dramatically changing the thesis of why to buy a JWB turnkey rental property, just because with how much it costs to build these right now, you're probably not going to be able to deliver the rent that would make it a good idea for us to do that and for you to ultimately spend more investment capital to do it. But I do think it'd be good for the marketplace, it'd be good for affordability, and overall in the marketplace, I think home values would go up over time if this was something that was enacted.
Yeah, as you were breaking down those numbers, I kept thinking, like, who's gonna build it, right? Like, if you're gonna spend $100,000 on something, you're essentially spending $100,000 to build like a one bedroom home in order to rent that out. Versus, what are the other things that you can do out there to find space or invest in something like it? These ADUs, like I could see myself building something like that because I want to take care of my mother,
right?
Or something like that. But as a sole investing decision of, I want to increase kind of like one more rental thing and get it. Seems like a hard thing to pencil out in my head as an investor that owns.
Well, it's all a numbers game. You would go to if you wanted to go to the nicer areas, and you could be in an area where you spend 100 grand to build an ADU, but you can get $1,400 a month in rent for that single studio apartment or efficiency or whatever we want to call it. Well, then it kind of makes sense. And now you might be able to get into a nicer neighborhood and have it still be a decent cash on cash return. So there will be a play. I don't know if it's the right playbook for us as JWB investors because there's too many variables, but overall, we're trying to help with affordability. So I think it'd be a good thing.
Yeah. And a handful of questions here. My tocayo Pablo Tolentino over here and another Not Your Average Guest asking, would JWB provide support in managing ADUs? Would you roll out like a way for like investors to do it? Like,
there's a lot of questions before we get there, but I can't see a reason why we wouldn't be able to support ADUs. Like, for example, right now, there are some properties that we manage that have accessory dwelling units on them. So we already do. So I don't see any reason why we wouldn't be able to support it.
And I don't see a reason why, like you guys, one of the benefits for JWB Property Management for me as an investor is like when it's time to like do a project in one of my homes, you guys manage that for us, right? So like I would imagine that if I have a home, I'm going to add an ADU to it, it would behoove me to like have it fall under the umbrella of JWB kind of like renovation department that you guys are already doing, right?
Yeah, absolutely. And we offer do the renovations for clients that want us to do the management for their properties already. So I think it would fit. Perfectly in line. Just give me some space to go and talk to the team and make sure I'm not missing something before we take it as the gospel here. But it would seem to line up with exactly the things that we already do really well.
And Patron Centaurus says, even without an ADU, I think large lots would potentially see a lift in values, right? It would make sense that kind of like when you upzone a downtown to go from like 6 stories to 13 stories, and now you can whatever lots go up, right? Like I would assume that lots that have extra space, just because the inherent potential for more stuff to be developed on it would go up in price.
The value would go up, especially if it's a bigger lot, but it's not a double lot. That lot size would go up dramatically, especially after this would be rolled out.
Sounds good. So those were the questions from earlier this week. We had a couple ones roll in that I don't want to oversee. Somebody asked here, Not Your Average Guest says, concerning reduction in property taxes, how would a drastic decrease affect quality of life here? Do you have any kind of like ideas on that?
And a reduction in property taxes, how would a drastic decrease affect the quality of life here? I think that's a really good question. I think that's why there's debate as to what do we want to do if we do want to eliminate property taxes or not, because we have to figure out how to pay for those essential services that affect our quality of life. I'm certainly not an expert on it. I don't remember how many billions would be need to be found somewhere in order to pay for those essential services that would not. Right now, they're paid by property taxes. So I don't know the answer to that question. I'm kind of with you. I love the idea of eliminating property taxes if there's not a decrease to quality of life and the essential services that keep us safe and all of that good stuff. And I think there's some theories about how to do that. I haven't seen where the numbers line up yet, but I'm curious to see how that works out. And I hope we make a really good decision, not just to drive housing demand, even though it would dramatically benefit everybody on this call more than most. I hope we make a good decision for all involved.
Yeah, Mike Foster pontificates in a comment. He's thinking that if they do eliminate property taxes for primary homes, maybe they start to say we should extra tax rental homes, right? So there's many scenarios at play here.
I did look into that. I've read many articles on that, and specifically, the governor has come out and said that is not what the plan is. It is not to throw the bill onto rental property investors. His plan has been to eliminate
like tourism taxes and consumption taxes and stuff like that. Right?
That's where a lot of people are going, is that now you're going to have a consumption tax, an increased sales tax to do it, which makes sense. And then there's the debate, is that the right way to go about it? Because a sales tax, is borne on a percentage basis, is borne by those who don't have the means to pay it. It's not a progressive tax, right? So you kind of go down this path, and like I said, I think there's good arguments on both sides. If we can figure out a way to make sure that our essential services are paid for and quality of life is high, and that, those who can't afford it or not, bear, an inordinate amount of the burden, then it would be a great thing. We'll see how it shakes out.
And Milady Jack Chatta has a perfect question here to kind of transition into the next topic that we talked about today, this idea of like the Iran war and how that affects housing. She asks, how would Jacksonville real estate, and especially rents and vacancy, play out if oil prices continue to rise and stay there for a couple of years? Do you have any kind of like overall macroeconomic thoughts on that? I can just put this question for you. So
okay. So Jacksonville real estate and rents and vacancy play out if oil prices continue to rise and stay there for a couple of years. Well, you know what? Oil prices, energy prices is a tax on everything. It is a major component of inflation, and it's really just a hidden or maybe not so hidden tax. And the real challenge is when you have high inflationary environments, you've got two things that are working against housing. You've got the Fed is going to increase the Fed funds rate, or at least keep it elevated, in order to restrict inflation. Because the Fed's, one of the two Fed mandates is to make sure inflation doesn't go skyrocket. Well, when you have energy costs, energy affects everything, so that leads to high inflation, and that the Fed responds by elevating mortgage rates. That's not good for housing in the short run. And then the other thing is that our long-term 30-year interest rates are more closely tied to what do 10-year Treasury investors think. Because our mortgage rates historically are about 1.7 to 2% higher than what the 10-year Treasury yield is. And so in inflationary times, people don't want to lend money as much because they understand that they're getting paid back and their values are getting eroded. They're getting paid back in less valuable dollars. So when inflation is high, that also means that bond investors, the demand is lower, and so the yield goes up. And when the yield goes up on the 10-year Treasury, that means that our 30-year mortgage rates are higher. Now, how does this all relate to Jack's question? Well, everything I just shared with you, if you continue to have really high energy spikes, it would likely lead to an environment where you would see decreased home sales because you'd have higher 30-year mortgage rates in that case. And it would be a temporary situation as long as energy costs are that much higher and as long as inflation is that much higher. But that's largely where it would land. And then ultimately, when it comes to home prices, when you have muted sales and depressed sales or declining sales because of high interest rates, it basically just pushes that buyer demand to the sidelines. It does not eliminate it. It just pushes it to the sidelines. And it's like a spring. It's like a coil. We've talked about this many times.
Yes.
And it would compress that coil because we have seen that in times where you have high interest rates, the coil gets compressed. And then when the interest rates come down, the spring releases. And you have higher than normal home price depreciation after this. The opposite was true in the age of easy money all through 2020 and 2021 and into 2022, where you had really low interest rates. The spring was sprung, right? Like the low interest rates led to a significantly higher amount of home sales, which led to significantly higher home price appreciation. So that's the way that it could play out if the war in Iran and the conflict continues and we can't get energy costs under control. It may lead to a temporary decline of home sales. And I think we still have a very high floor for pricing because we have a low supply of pricing.
And a growing market.
So I don't see this cratering the housing market, but it could be a temporary just kind of pushing off the appreciation that we would have expected until energy prices come back down.
So did you see, I showed the slide that you had from last week on kind of like the effects of the war that talked about these oil prices. I'm surprised you didn't mention the slide right after it is the idea that, if this is happening, if oil stays at a high price, the supply is also not going to be built either, right? Like
Exactly.
it adds cost to materials, it adds cost to bringing new supply to market. We are still undersupplied. So, I wonder where that equilibrium point is of just like, I don't know. It just feels like this asset class continues to mitigate itself. Whenever you start pulling any kind of lever, it just balances out into more like flatness than retreat when it comes to specifically workforce housing in a growing market that is still underpriced in comparison to the rest of the US with job growth and like population migration.
Exactly. This is why I love this asset class so much. This is why I believe this asset class is so good for you when you're planning really important life events like retirement or sending your kids or your grandkids to college or whatever you are working towards. You want to be in an asset class that performs really well in tough economic times and has the opportunity to perform really, really well in good times. And that's what single family rental properties are. And I'm so glad that you brought this slide back up because we tend to think of the demand side only, but it's supply and demand. In that environment where there's war, there's high energy prices, there's inflation, well, that means there's higher interest rates. Well, what that also means is that supply is further restricted because those high interest rates would affect a builder in a similar way. Builders are not going to go way out of their way to build a lot of homes in that environment because sales are slow for them. Why would they do that? And it's more expensive to build at that time. Their profit margins are reduced because of the higher borrowing costs. So this is kind of like in many cases, it's a self-regulated type of investment where in a worst case scenario, you still wind up pretty darn good. And we can relate this back to why interest rates have been so high for the last 3 years and home prices haven't gone down. That's why, we are undersupplied. And we can go back even, at other times where, we had COVID and we had this foreclosure moratorium. And I mean, all of these things, there's so many ways that you can come out in a really good position of strength when you own single family rental properties. It's not perfect, not guaranteed, but compared to other asset classes, you have so many ways to kind of self-regulate. And that's what we see here.
And speaking of going back, GC, as we were preparing for this show here about war, you went back and compared essentially like housing market indicators based on the last 3 or 4 conflicts.
Yeah.
Talk us through this.
Yeah. So the question that Pablo gave me is, hey, listen, let's do a deep dive into how U.S. housing performs during war times. Let's go out a little bit farther than just what we're experiencing right now. And the question was, is there a correlation between how housing does in wartime? Does housing appreciate or does housing go down? And so I went to the last 4 conflicts. I brought the data nerd in me out and I pulled all the data and tried to compile it. And I looked across a number of different parts of the economy or economic factors, as well as timelines for each of these conflicts. So here's my thinking. I was like, okay, Well, let's take a look at the year before the conflict. Let's take a look at the first year of the conflict, and then let's take a look at 3 years into the conflict. My thought was, well, we need to understand what's going on in the economy and in housing before, because we might find that whatever was happening before largely was continuing. And then in the first year of the conflict, I wanted to see if there was a shock. If there was a shock to the system due to the war. And then in the third year, my thought was, well, things have largely become a little bit more normalized by that point, and things would probably have tamed down, and the economy would be performing at a way that was probably going to be what it was going to do absent of the war, was my idea. So those are your 3 timelines. And then I looked at inflation rate, I looked at an unemployment rate, I looked as to whether or not we were in a recession, and then I wanted to see the impact on mortgage rates, home sales, and home price appreciation. How did I do for my data nerdness?
Pretty good. Pretty good.
Pablo, before the show, he's like, hey, man, I think we're just going to have a conversation about this. I'm like, I'm going to let my data nerd take over here. So for all you data nerds out there you go.
You walked into the studio like, I did way more work than you told me to. Yeah.
I wanted to make sure that we're grounded whenever we bring a thought to you guys. So this was and the other thing was I looked at the 4 conflicts because I wanted to look around 1990 or later, because that's where our housing data and our economic data becomes a lot more reliable here in our country. So the first one was the Gulf War, 1989 to 1992. And you can kind of see all the numbers here. What I started to see was not some correlations when it came to what war did in terms of home prices. So we'll take a look at that. But I started to see a lot of correlations to what was going on in the economy in terms of inflation, unemployment, recession, and what did that do for mortgage rates. So, the scaffolding here is, okay, war is a part of what is going on in the overall economy. What's going on in the overall economy leads to interest rate consequences, either interest rates for our 30-year mortgages going up or down. And that is the biggest driver for U.S. home sales and home price appreciation rate. So I highlighted these 2 because, and just to give it some perspective, the average inflation rate, the consumer price index over the last 40 years or so in the U.S. is 2.8%. So I'm looking at that and I'm saying, all right, well, the year before the conflict, we were about 4, spiked up to 4.8, and now it's at 4.2. So if I'm the Fed or if I'm bond investors and thinking about 10-year Treasury, I'm like, well, it's not exactly flying off the rails, a little bit inflated, but not exactly going to 8% or 9%. Then I looked at unemployment, and unemployment was largely around 5.5%, and then it started to spike in 1991. And so that spiked to 6.8%. At the same time, we had a recession in 1991. So the Fed, when they see recession, if they don't see inflation just raging, right, they're likely going to drop the Fed funds rate.
Right.
And if inflation isn't raging, then you're largely going to see the 10-year Treasury yield start to go down, because in inflationary times, people look for safety and comfort, and many people go to bonds. So all that to be said, you started to see average 30-year mortgage rates drop from about 10% to about 9% in those couple of years. And home sales largely stayed the same. And interesting, because this is counter to what we talk about. Drop in interest rates, but home prices actually went down in 1991.
Yeah. Well, home prices slowed down.
Thank you so much. They didn't go down. They decreased to only 3% home price appreciation. Thank you for catching me.
Yeah. Okay. So let's look at the next one. The next one is Gulf War and Iraq War, right?
Yeah.
Closely related.
Yeah, there you go. A lot of these are related, even for timelines, as we'll look at the next one here.
Totally.
So here, again, just kind of looking at what's going on, inflation and employment, recession here. Inflation is largely in check from the beginning of the Iraq war from 2002, 2003, and then 2005. Going up, but not anywhere close to, 6, 8, 9% like we've seen recently. Unemployment was largely where it should be, right around our historical average. We were not in a recession. And the Fed kept the Fed funds rate really low. And so you started to see mortgage rates go low. And when you see mortgage rates go down, you generally see home sales go up, and then you also see home price appreciation go up. And that's what we saw during the beginning years of the Iraq War.
Okay. So right now we had one where home price appreciation slowed down, one where it went up, right? Like during times of conflict. Next one, Afghanistan war.
Yeah, absolutely. So, okay, looking at inflation here, largely in check. We went from 3.4 to 2.3%. The Fed's mandate is a 2% inflation measure. So no concerns with inflation. Unemployment ticking up, right? Went from 4 to 6%. So cause for concern there. Was the U.S. in a recession in 2001? Yes, we were. So now the Fed at that point, if they're looking at it and they're saying, well, I got an unemployment problem, but I don't have an inflation problem, they're going to drop rates. They're going to drop rates. And that's what they did. Again, if you don't have an inflation problem and you've got a recession, people are scared and they look to put their money in bonds. And so because of those two factors, your average 30-year mortgage rate dropped to 5.8% in 2003, the third year of the conflict. And guess what happens? Just like we talk about, interest rates drive housing, not necessarily wars, right? Here you saw U.S. home sales skyrocket from 6 million to 7.3 million from 2000 to 2003. Home price appreciation again went up. It was already elevated at 7.6% per year. That's way high compared to the historical average, but it ballooned up to 10%. And obviously there's other factors here. Loose lending standards was clearly a part of this as well. But the lens here that we're trying to look at is, does the war cause this? No. The war is one factor that leads to the overall economic picture, which leads to interest rates. And then absent of unusual things, low interest rates will lead to high home sales and high home price appreciation, or the opposite.
Okay. So far you're essentially painting a picture of the war is like one color of all the crayons that you have, and it doesn't seem to be like the darkest color that affects all the other colors kind of thing, right? Like,
true. It is a big factor.
Yeah.
But wars can be either inflationary or deflationary.
Yeah.
Right? It can be inflationary because you can have a supply shock to energy, like is what we're seeing right now. That's inflationary. We're feeling that.
Yeah.
You also have a lot of government spending, which is inflationary. But it can be deflationary as well because people are scared and people don't spend as much money. They don't invest as much. So it can be deflationary as well. But you got to see the bigger picture, and it's all about the economy and then what happens with interest rates.
Got it. So then the Ukraine war.
Yes. So the Russia-Ukraine war here, again, started out at about 4.7%, which is a little higher on the inflation rate than the Fed really wants. I would think, somewhere around 2 to 3% is really where they want to be. So a little high, but then it skyrocketed in 2022. We had 8% CPI inflation. That's the most that we've had in 40 years. And when that happened, we didn't have an unemployment problem, but we had a big inflation problem. So what do we think the Fed was going to do?
Jack up rates.
Jack up rates. What do you think bond investors did not necessarily want to do? They didn't want to put their money in bonds and 10-year treasury because they understand that when you lend in inflationary times, it erodes your wealth. So because of those two factors and because the government stopped buying mortgage-backed securities and bonds, we saw interest rates go way up. They went from 3% in 2021 to almost 7% in 2024. And it's all about interest rates. So what do we think happened to home sales? Well, home sales went down significantly. Now, those people that didn't buy homes are not saying I'm never going to be a homeowner again.
Yeah.
They're just waiting for interest rates to come back down, to come back off the sidelines. But that's why you see home price appreciation go from about 17% in 2021 to about 3.5% in 2024. Interesting. Your interest rates went so high, more than doubled, but you still had 3.5% percent home price appreciation. Gosh,
you're almost there.
Almost there.
Yeah.
And that just shows you what we started talking about before, that you have so many ways to self-regulate yourself when you invest in single-family rental properties because of supply and demand.
This was really good, man. A bunch of numbers, cool, like dive into the data. MVP Lee is saying, love hearing the math guru Greg explaining the big picture. Michael Santori is talking about the 8% inflation jump in 22 was a 40-year high. That was a lot of numbers, a lot of things coming at us. What are the takeaways? What did you see?
Yeah, number one, housing performance does not move in a consistent direction during wartime. So in the 4 examples that I shared with you, which are the most recent and the best data that we have, Appreciation happened twice, and we saw we saw slowdown
Yeah.
twice. So it's not like every time there's a war, it just automatically juices home price appreciation. And it's not like whenever you have a war, there's going to be less than normal home price appreciation as well. It's more of a factor of what's going on in the overall economy.
Got it. So takeaway number one is there is no like direct correlation between home prices and wartime. It's more what's happening in the economy as a big picture of things dictates what's going to happen.
With the caveat that home prices have gone up in the last 4 conflicts.
Correct.
So certainly no depreciation. But yes, exactly what you said.
Makes sense. All right. Takeaway number 2.
Mortgage rates show the strongest correlation to housing performance. It's more about what's going on in the economy and then what happens with interest rates. And that is what leads to either increases or slowdowns in home sales and home price appreciation.
Okay. And then last takeaway?
Kind of reinforcing what I mentioned there a second ago. Housing is driven by economic cycles. It's not geopolitical cycles. The geopolitical cycles are a part of the overall the economic place that we're in and the cycle.
Mm-hmm.
And from that, it's about interest rates, and that's what affects it. So it's not about geopolitical.
Good work, man.
Thanks, man.
That was, I just thought that we were going to just rehash the same thing that we talked about last week and answer some questions. You put some real work into you activated the nerd brain. You came up with some stuff. I think that's pretty tangible, right? Like seeing those numbers, seeing that in some of them home prices accelerate and some of them home prices decelerate. We don't see home prices going negative at any, in any of those moments. But if you look at the overall economy, you see a bigger picture, right? Like this continuation of mortgage rates being the thing that is the most correlated, right? That's the strongest color in the crayon box. I'm gonna develop this crayon analogy.
I'm colorblind, so don't go too far down this one.
Yeah, that's true. That's a bad one. That's a bad one. Yeah, got it. So anyways, the blue-green.
Terrible. Terrible.
I'm sorry. Yeah. Anyway, so mortgage rates being that, and at the end of the day, housing is a function of economic things, not just geopolitical things. I think that is something that when I first started investing, I got that twisted, right? Like I think I got, I had done private lending with you guys. This was like 2014. Then all of a sudden, by the time it came up, it was an election cycle. And I just started thinking, well, what of the election? What of this?
Right.
What we continue to see on the show is that, housing is has this, it's like the trees in the forest versus the, versus the sun up and sun down kind of thing. Like it's got a much longer life cycle, bigger aperture. It doesn't move very quickly. But it, it stays relatively consistent, and it's like a cruise ship instead of a speedboat.
Exactly.
That doesn't just react to certain things like that.
When you're thinking about places to put your money right now, we have to resist making your decisions based on what's going on in the latest news cycle.
Yeah.
I mean, the latest news cycle doesn't last longer than a day sometimes, and hopefully this conflict in Iran will be over at some point soon. And when it happens, we already seem to know the playbook, right? We had lower mortgage rates before this. We know why they have gone up as energy supply is not artificially restricted anymore. We'll see interest rates go down. And when you see that, you will see all that pent up demand on the sideline come back in. You'll see home sales go up, and then you'll see this, coil effect of pent up home price appreciation happen at some point. And I don't know when it's going to happen, but I know that the war in Iran, while our hearts are going out to all those who are affected, this really should not affect your rental property investing strategy.
Makes sense. You're getting some kudos in the chat for not making this political in any way. But I think you're reflecting what we're saying, right? Like the home price, the rental property investor, does not, should not be swayed by political situations in general, right? Like I think if you look in our chat, we have people that are in all colors of the political spectrum, that we all play nice because we all understand, hey, at the end of the day, this is the one place that is pretty apolitical. It's just a critical need. It's a matter of fact. It's part of the spine of the U.S. economy, particularly in workforce housing. It's something that everybody needs. You're investing in something that is undersupplied, that has extra demand to it. It's a really, really consistent experience that allows us to all kind of opt out of the wild swings of the news cycles and things like that. And I like it, man. I think it's a unifying force, which I really like.
Awesome. Appreciate the comment there. I try really hard to make sure I'm bringing everything that I can to you guys and making sure that all sides are represented.
Yeah, love it. This was great. I want to thank the community for showing up, asking these questions. I want to thank you for showing up. Last week was the biggest attendance that we've had in like 6 months.
Yeah,
right?
over a year.
Over a year.
Yeah.
So it's still not wrong.
Yeah. There we go.
Just saying. Biggest attendance we had. We love you bringing your friends. We love you showing up. Again, we keep our promises. If you ask questions, we don't get to them. We either make a show out of them or we come back and we come with the research, right? So like, don't get discouraged if we don't get to your question on a particular show, especially the market update, but just keep showing up. We'll keep educating you and we can't do it without you. So thank you to the community that takes an hour out of the middle of your workday to show up every single week. We can't do it without you. And next week, we're going as far as possible from this like war piece into just really tactical decision making. We keep hearing from people that Detroit is kind of like a darling in this like rental property investing class right now. So we're going to do a market to market comparison. I know Leslie Wilson has some opinions on this about the Detroit market, but we're going to do a Detroit versus Jacksonville, like comparing the markets, comparing the asset, the returns, the experience, and the things that you can expect from the two markets, because we're hearing that a lot in these conversations. Again, proving that the topics that we do here come from what you want to hear as much as freaking possible. So let us know what you want to hear, and we will make shows about it. GC, good job today, buddy. I'm really proud of you.
Thanks,
that
man.
wasn't easy.
Appreciate it.
And any advice for people before the next show?
Don't be